Middle school dances have been awkward for every single middle schooler throughout all time and all history.
True statement.
True statement. As the dancing begins, toes are stepped on. Miscues are happening all over the place. It's just an awkward time. And as I think about the dance between Social Security and the IRS and the taxation of those things together, it's kind of like a middle school dance where there's toes being stepped on. Chaperones are laughing inevitably at what is going on. It's just really complicated.
Yeah.
And it's messy. And it can be funny, but it can be really challenging.
Yeah.
And so as we think about the challenge and the dilemma of how do you figure out what of my Social Security benefit is going to be taxed, as I'm trying to figure out work and Social Security benefits, what's withheld, what am I able to keep, what am I able to use,
Sure.
All those things can be really hard to parse out. So Spencer, as we think about Social Security, income taxation, and then benefits withholding, what do we need to know?
Well, and it's even worse. I'm going to go even one step farther on the middle school dance analogy, because you have that guy that goes over to the punch bowl and he starts sipping out of the punch bowl. And this is kind of what the IRS is doing to Social Security as well, because they're taxing your income on the way in. So you have to pay tax on the income that you pay to FICA. And then when you get the benefit, we're talking about that benefit being taxed. So It's a double dip.
Right.
So an interesting way that the IRS has set up the tax code that legislators have. But as we think about it, we want to think about a couple of things. First, penalties, and then how benefits are actually taxed. So the penalty side of things, if you're not aware, if you take your Social Security benefits prior to your full retirement age and you have earned income during that time, you may have a payback amount that you're required to pay back those Social Security benefits that you've already filed for. So let's say you're in this scenario, you're age 62, you come to a point where you think, okay, it's time to retire. You do so. 6 months later, someone comes and knocks on your door and says, hey, I'll pay you a princely sum to do some consulting in this area, and you happily oblige. Well, you're already getting that Social Security benefit. Let's say you decided at age 62 that you were going to file for the benefit, receive that. Because it's prior to your full retirement age, which is 66 or 67 or somewhere between the two for most folks these days who are approaching retirement, then there will be a payback amount. So in 2023, you can earn up to $21,240 before your full retirement age and not have to pay any of that Social Security benefit back. Now, the caveat here is that during your full retirement year, during the year that you attain your full retirement age, I should say, you have a little bit higher level of opportunity there to earn. You have up to $56,520 that you can earn in that particular year when you attain your full retirement age. So you have more latitude there. Now, if you earn any amount of income beyond your full retirement age, there's no payback in the Social Security benefits. So again, let's come back to that first instance where we have you're earning too much. Let's just say you earn $61,240 of income. So that's $40,000 above and beyond what the threshold is. And let's just say that you are going to have $40,000 of Social Security income through the course of a given year. So you have an amount that's $40,000 too high and you have $40,000 of income. Well, there's a payback of every $2 of income, you have to pay $1 back in Social Security. So because you're $40,000 above, you've got to pay back $1 for every 2 of those. So you got to pay back $20,000 of that Social Security benefit that you were receiving. So because, again, that benefit was $40,000, you're having to give back half of that benefit to the government because, again, you're making too much money. Now, the silver lining of this is actually there is a formula and a calculation that the government uses such that that income level does contribute to a higher benefit level down the road for you. But our recommendation always is to try to avoid having to do that payback if at all possible. For simplicity's sake, for accounting's sake, for a lot of different reasons. So that's one dynamic in terms of that penalty or that payback that is required. The second piece that's even more fun. I mean, that was a mouthful, unpacking that. The second piece that's even more fun is figuring out how much tax you owe on the Social Security benefit that you receive. Mm-hmm. So we've got this way that they calculate income that is used nowhere else, and it's called provisional income.
Sounds about right.
Yeah. And just like, middle school dances, there's things that happen there that you scratch your head and say, nowhere else in the world would I see this except at a middle school dance. Same thing with Social Security taxation calculation. What they're going to do is the calculation to get to provisional income, again, this all-important number here, is that you take all of the income, essentially, that would be applied towards your modified adjusted gross income, typically. So we think about all of the income that you would have, earned income, all of the interest income, even all of the municipal bond income that you would have there. That's one piece of modified adjusted gross income there. So you take all of that income except for Social Security. And Social Security, what you do is you take half of your Social Security income and you use that along with everything else that would be in that modified adjusted gross income bucket. You add those together and that is your provisional income. So provisional income, there is a certain amount of provisional income that you can have that essentially allows you to have zero Social Security income pulled in. So let's say you had $30,000 of overall Social Security income, nothing else. Then your provisional income would be $15,000. In that circumstance, because you're below the lowest threshold, which is $25,000 for those single filers, $32,000 for those who are married filing joint. Because you're below that first threshold, there's no amount that is brought into Social Security for taxation. So no amount of your Social Security is taxed there. So once we get above that first threshold there, which is again $25,000 for those who are single filers, $32,000 for married filing joint. Once we get above that threshold for provisional income, then for every $2 of income above that, $1 of Social Security is brought into your ordinary income to be taxed. So for those who are single filers, again, that window there where for every $2 of income, of provisional income above it, you have $1 of Social Security brought in. Again, that is from $25,000 all the way up to $34,000. For those who are married filing joint, it's from $32,000 up to $44,000. So for those married filing joint, you got about a $12,000 window in there. For those single filers, you have about a $9,000 window in there. Once you get above that first window, for every additional dollar of provisional income, you bring in 85 cents of your Social Security income into ordinary income. So it may be tough to visualize as we're unpacking it here, but we're going to show you a few examples, we hope, that will give you a better idea of how this calculation is actually put together. So we're going to look at this couple, John and Jane, and we're going to look through 3 different examples for them to give you an idea. Let's say that they have, in this first example, $80,000 of Social Security income, and they have nothing else in terms of income. Well, $80,000 of Social Security income, if you recall our former unpacking of the provisional income formula, we take modified adjusted gross income, that's everything outside of Social Security, which is 0 in this first example. And then we take that $80,000 of Social Security and we take half of that. So that's $40,000. We add 0 and 40, and of course $40,000 of provisional income. Now, as I mentioned, the first threshold there is $32,000 for those who are married filing joint. So they're $8,000 above that $32,000 threshold. So 50% of that $8,000 is what is included from Social Security into their ordinary income. So only $4,000 of the $80,000 that they have of Social Security income, only $4,000 in this example is included as ordinary income on their tax return. So almost nothing. You think about the amount of income, $80,000 is a healthy amount of Social Security income. And yet in this particular example, because they have no other income, they will have almost no tax that's due on that. Now, let's take this example and let's think about it in a different way. Let's say that John and Jane, in this part 2, they have still $80,000 of income, but let's say half of it now comes from Social Security and half of it comes from IRA distributions. Let's just say in this example, maybe John is deferring his Social Security, Jane's taken her Social Security, it's pretty healthy Social Security, and then they're supplementing that with IRA distribution. So again, $80,000 of overall income. We take the modified adjusted gross income number absent Social Security, and that number is $40,000. We're going to add to that half of the Social Security, which is also $40,000, of course, divided by 2 would be $20,000. So we take $40,000 of modified adjusted gross income plus the $20,000 there. And then we have $60,000, which is the provisional income. Now, this is where the calculation gets a little bit more complicated. You can see in that first bracket there, from $32,000 up to $44,000, we're only including 50 cents on the dollar of Social Security into ordinary income. So of that $12,000, again, that we go from 32 up to 44, we're including $6,000 there. Now, above $44,000, we include 85 cents on the dollar. So we've got $16,000 between our total amount of provisional income of $60,000 minus that second threshold there of $44,000. We've got $16,000 there that we're taking 85 cents on the dollar. So that is $13,600 in that second tier. So we take $13,600 and we add $6,000. So we have $19,600 of Social Security income is included in ordinary income. So that's about half in that circumstance. So let's think about a third example. Let's just say that in the third example, we're taking everything from that second example, except we say that John and Jane have a conversation towards the end of the year and they feel like they need to take another $20,000 of income from their IRA to pay for a home renovation that they want to do. If we take that $20,000 out and then that's added to their overall income, that means that now they have $60,000 in kind of that modified adjusted gross income bucket outside of Social Security, but that's going to have an overall impact there. So again, we take that $60,000, we've got half of Social Security, again, is $20,000, so we've got $80,000 of provisional income in this example. Just as we did last time, we look at the first tier, that's $6,000 because it's 50% from $32,000 up to $44,000. So $6,000 of Social Security income included in that first tier, but the second tier now ends up being much more significant because we have $36,000 now in that tier. So the $44,000 all the way up to $80,000, again, is $36,000. If we take 85 cents on the dollar of that, it is $30,600. So we add that first tier of $6,000 to the second tier of $30,600 for a total of $36,600. Now, the note here is that that's more than 85% of the $40,000 of income that they have. So they have $40,000 of Social Security income, and by law, you cannot have more than 85% of that income included as ordinary income. So we look at this calculation and we say, okay, what's the lesser of what's 85%, and that is $34,000 there. So you can't have more than 85% of your Social Security income included as ordinary income, and in this circumstance, via this calculation, they're only going to have $34,000 included. The thing I want to highlight here, though, is that $20,000 of distribution from their IRA, they have to pay tax on that amount, but that distribution also means that they have more of their Social Security included as ordinary income. So there's kind of this shadow tax that we see going on here because you get hit twice on that distribution. You get hit once because you're taking the $20,000 out, so you have that much more ordinary income, but you also have a substantial amount more. You can see in the example, you have about $14,400 more that is included from your Social Security income that's included now in your ordinary income because you took the IRA distribution.
Well, that sure felt like a middle school dance. It felt like I was watching Social Security and the IRS hold each other at arm's length and just sway and think, I don't want to get anywhere closer. This is as close as I want to get to you.
Yeah.
So Spencer, as we think about action steps, what do people need to know and what action do people need to take?
Well, first, there's more complexity here. And so one of the things that we want to be careful about is doing some kind of back of the envelope calculation, or maybe using an online calculator that doesn't incorporate all the elements of Social Security. Because there's complexity here and we don't really know until we do some deeper dive analytics what the implications are, we need to be careful.
Yep.
It's kind of like, asking somebody to dance at that middle school dance. You don't really know what's going to happen there. It's a little bit awkward and weird. The other thing that I think we want to recognize is that this needs to be looked at in concert with when you take Social Security benefits. Oftentimes we will be advising clients to defer at least the higher income earner of a couple in taking Social Security benefits. And this can have two positive impacts. One, it can actually increase the amount of expected income over the course of a lifetime. But second, it can actually also help with taxation, believe it or not. Because sometimes we'll see clients retire in their early 60s. They will take distributions from IRA or Roth or other sources for a period of time so they can defer Social Security out to at least full retirement age or age 70. In doing so, what they're actually doing is also oftentimes reducing the likelihood that they have a significant required minimum distribution at age 70, which means that they'll have less income there, but more income with Social Security. The more income that you have actually with Social Security, the better tax treatment oftentimes that you get in these types of circumstances. So it can have really two positive effects if we time all of this correctly with the benefits and with the Social Security tax planning all together. So this is one of those areas that we always say, look at a coordinated plan. This is really one of the areas that we want to stress that coordinated plan. Again, we've given some examples here, but they are not specific to any one particular situation. So it's important to work with your financial professional, tax planner, and bring together a plan that makes the most sense to help you achieve your financial goals.
Great. Well, thanks, Spencer. We'll see you guys next time. This content was provided by Retirement Planning Services. We're in Knoxville, Tennessee, and you can visit our website at www.seriousretirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents.